Welcome to the Deep Dive. Today, we're taking a really granular look at the Q3 2025 results for Assured Guaranty, that's ticker AGO.
Right, the financial guarantor that, really stands between lenders and default.
And if you follow this stock, you absolutely saw the drama. The earnings dropped after hours, but it was that pre-market call the next morning that was just jet fuel.
Total jet fuel. The stock closed the day up, over 6.5%?
Massive move. And that kind of reaction, it demands attention. The market clearly found something powerful in these numbers, and we need to figure out why this quarter was so different.
It absolutely was. So our mission today is to really unpack the engine behind that move. We're going to dissect how AGO pulled off that substantial earnings beat.
And figure out what it means for their valuation, right?
Exactly. We'll look at the capital metrics and, more importantly, decide if management's, really aggressive optimism is actually justified.
It sets up the central tension immediately, doesn't it? Is AGO this sort of stagnant, deep value stock that just throws off capital?
Or are we seeing the pivot, the beginning of a sustainable growth compounder? That is the ultimate question. And to start answering it, we have to look at the headline figure that kicked it all off.
Okay, so let's start with the money shot, the number that really grabbed the street's attention. And it wasn't the GAAP net income, which actually looked a little softer.
No, not at all. It was the non-GAAP adjusted operating EPS. For anyone tracking specialty insurers, this is the metric that matters. It strips out all the noise.
The fair value stuff, you mean? Like derivatives and foreign exchange.
Precisely. It gives you a clean look at their core underwriting profit and their investment income. And that figure came in at a staggering $2.57 per share.
$2.57. And when we say staggering beat, just how big are we talking here?
I mean, the magnitude is the entire story. That $2.57 was about 70% higher than the consensus estimate.
70%.
Yeah, the street was hovering around, $1.50 maybe. So they didn't just meet estimates. They completely obliterated them. Even against a strong quarter last year, it was up 6%.
And you mentioned the GAAP figures looked less favorable. GAAP diluted EPS was $2.18, which is actually down 31% year over year. So why did the market just completely ignore that?
Well, because the GAAP number, by its nature, it includes all that non-cash volatility. The street is betting on the long-term cash generation, on the underwriting quality.
Right.
So when a financial guarantor beats that adjusted metric by this much, it's just confirmation that the core business is firing on all cylinders, regardless of the quarterly accounting stuff.
And that core performance, it's translating directly into shareholder value. Management really hammered home the record capital figures.
They did, both adjusted book value per share at $181.37 and the adjusted operating shareholders' equity per share, $123.10. Both were all-time highs.
Those per share numbers just tell the whole story of successful capital compounding.
It's not just that they made the money. It's that it stuck. And that momentum wasn't an accident. It was built on a really significant resurgence in their production.
Which brings us to underwriting. This is where we start seeing some signs of that growth compounder narrative taking shape. We saw gross written premiums, or GWP, at $75 million. That's a 23% jump year over year.
Yeah.
But the truly explosive number, the one that points to future revenue, was PVP.
Present value of new business production, it hit $91 million.
And that $91 million? That's a 44% jump year over year. It's also up more than 40% just from the first half of the year.
A huge acceleration.
So that kind of spike needs a clear driver. What fundamentally changed in the market to allow that?
It was a shift in the U.S. municipal market mix. Management was really clear on this. Earlier in the year, a lot of the BBB-rated muni issuers, which are, the sweet spot for AGO's insurance, they were holding back.
Waiting on rates, I assume.
Exactly. So the market was skewed toward these ultra high-rated deals where, frankly, a guarantee isn't necessary. Q3 saw the return of that BBB-rated supply, which brought the market back to a more typical and, for them, more profitable risk profile.
Wait, but isn't that a bit of a double-edged sword? More BBB supply means they're insuring riskier deals. How do we know they didn't just lower their standards to grab that volume?
That is the right question to ask. And I think the confidence comes from their sheer market dominance. They can be incredibly selective.
Okay.
Year to date, AGO guaranteed something like $21 billion of par in the primary market. And in doing that, They captured roughly 63% of the entire insured U.S. muni market.
63%? Wow, that's up from...
Up from 57% a year ago.
Yeah.
So when the goods supply comes back to the market, they just sweep the field because their AAA plus ratings are so valuable. They're consolidating share while staying disciplined.
So the volume is normalizing, and their quality lets them capitalize.
That's the story. Now, while that production momentum is strong, we do have to touch on the overall revenue picture. JAP total revenue was $207 million, down 23% year over year.
Which sounds scary if you just read the headline.
It does. But when you dig in, the decline wasn't driven by weak insurance premiums. It was largely from volatility in those non-core items we talked about: FX, derivatives, lower realized gains.
So what did the core earnings power look like?
That's the key. Net earned premiums were $94 million, only down a tiny 3%. And more importantly, net investment income was also $94 million, which was actually up a really robust 15% year over year.
Okay, so the investment portfolio strength and the recurring premiums are offsetting that non-cash noise.
Exactly.
That reframes the challenge. I mean, it's one thing to generate a massive EPS beat, but as a guarantor, it only matters if it sticks to the balance sheet and they manage it well. Let's talk capital management.
Capital management is the defining theme of this quarter. CEO Dominic Rico was just laser focused on this idea of continuing to build shareholder value, and the numbers absolutely back him up.
In Q3 alone, they returned $134 million to shareholders. That was what, $118 million buybacks and $16 million in dividends.
And then they immediately signaled more to come, adding another $100 million authorization right after the quarter.
The cumulative impact of that is just massive, and it's why those per-share metrics are at record highs.
It is. By the end of Q3, Aggo had repurchased roughly 9.7% of the shares outstanding from the start of the year.
Almost a tenth of the company in 9 months.
Retiring that much of your float is an incredibly powerful way to compound book value per share, even if your net income is basically flat.
That commitment to capital return is one side of the coin. The other is how they're strategically changing the business they underwrite to accelerate that process. They're focusing on velocity.
That capital velocity is the key to the whole growth compounder argument. They're finding growth in new places, most notably in their secondary market muni strategy. That little side business is booming. It produced $32 million of PVP year to date.
That's nearly 3 times what they did in the secondary market for all of last year. That's not a side business anymore.
No, it's a real developing business line. It's about 7% of their U.S. public finance par written now, which shows real traction outside the new issue market.
But the real pivot seems to be in structured finance. They're moving away from those huge multi-decade deals that used to define the industry.
Yes, they're pivoting toward shorter duration, repeatable transactions, specifically subscription finance, which is basically ensuring commitments to private equity funds.
Interesting.
Management said on the call that new structured deals are maturing within 5 years. Think about that. That is 2 to 3 times faster than the business they wrote just a decade ago.
So the same dollar of capital is now being released and recycled 2 or 3 times faster than it used to be. That has to dramatically improve their ROE.
Precisely. It turns the franchise into a faster, nimbler machine. It reduces the time their capital is tied up, letting them write new, high-quality business more often.
And speaking of juice, their investment portfolio is still pumping out some pretty substantial non-underwriting income.
Absolutely. Their alternative investments, which includes funds managed by Soundpoint, have delivered an annualized IRR of about 13% since inception.
13% is a phenomenal risk-adjusted return, way better than what they'd get on a typical bond portfolio.
For sure. And we also have to mention the legacy book. It's still there, but it seems to be shrinking in a good way. The quarter saw a $38 million net economic loss development benefit.
Which is essentially found money.
It's found money. It came from cleaning up old exposures, mostly legacy RMBS and some non-U.S. public finance stuff. It just validates their ability to manage and liquidate worst-case scenarios, which is critical.
That positive reserve development is a huge psychological boost for investors. But we can't ignore the tail risks that still worry the market.
That's right. And management spent a lot of time on the Q&A addressing those credits, like Puerto Rico's prepay and the tricky UK water exposures like Thames Water. These are legal quagmires.
They kept citing their 4-for-4 track record on RMBS recoveries and their aggressive legal approach. It's a good reminder that this business is also a massive legal game.
It really is. They aren't just betting on probability. They are betting on their lawyers. And you could tell the analysts were zeroed in on this. One of them asked specifically about the path to reserve development on prepay.
The market's watching the legal path, not just the financial probability.
Very closely. Their whole ability to retire that prepay risk hinges on their vigor in enforcing their legal rights.
Value investors seem comfortable with this, especially with KBRA reaffirming their ABA Plus rating in August. But looking forward, management was extremely bullish on the pipeline.
They said they were very bullish on growing production and compounding that ABV per share. And they're not just waiting for the muni market, they're chasing new growth vectors.
Like what?
Global infrastructure, for one. And fascinatingly, they said they're evaluating opportunities in the surging data center capex cycle.
Ensuring the municipal bonds that will build tomorrow's AI infrastructure. That's a powerful story.
So here's the split narrative we see. Value investors see this deeply discounted, capital-rich company with top-tier ratings. They love the buybacks.
But the growth investors are still cautious.
Right. They look at the muted top-line GAAP revenue growth over the last few years, and they still see a company with, modest growth prospects no matter how powerful the capital compounding is.
And the stock performance supports that view. It's been basically flat over the last year while the S&P 500 is up double digits. It sets up this really interesting tension on a high-quality name priced like a low-growth utility.
Yeah.
All right, before we wrap, let's transition to our segment.
Yeah.
This is not financial advice. This is purely for educational discussion. We're just exploring interesting concepts based on the call.
Okay. So given the aggressive buybacks and management's absolute confidence in resolving these complex legacy issues, we're pitching an outrageous but plausible bet. A long ago, short-leveraged credit exposure pair trade.
Okay, that is delightfully complex.
Yeah.
Unpack the rationale for us.
The trade really rests on the idea that the market is still pricing a go like a boarding value play. It's ignoring the aggressive capital return and, more importantly, the potential for found money from cleaning up that legacy book.
So you're betting on their management competence against general market weakness.
That's it exactly. The mechanism is simple. You go long ago to benefit from that 9.7% flight reduction and the compounding book value. At the same time, you short a similar amount of a high beta below investment-grade infrastructure security.
Like a distressed rail or a speculative utility bond or something?
Something like that, yeah. Something that relies on a complex workout. So you are hedging your exposure to general credit risk, but you're making a specific bet that AGO's legal and underwriting teams are just plain better than the rest of the market.
So the whole bet hinges on them successfully extracting value from those old messes.
Right, precisely.
Yeah.
If they keep generating these lost development benefits, like the $38 million this quarter, it acts like an embedded call option that boosts book value way more than anyone expects. By pairing it with a short on a risky credit that might fail its own workout, you're betting on the strength of OGO's franchise. The market will eventually have to re-rate this cheap insurer once those tail risks are gone.
An intriguing concept. It really all comes down to management executing on that 4-for-4 confidence level.
So to recap, the Q3 story for Assured Guaranty was all about capital accretion and production momentum. The $2.57 adjusted EPS beat and the record ABV per share, they just validated the whole strategy.
And the central tension going forward is whether AGO can sustain this new business production, that huge 44% jump in PVP, long enough to convince the market that it's not just a deep value story, but a reliable growth compounder.
Yeah.
The lesson here might just be that AGO is swapping out the legacy headaches of Puerto Rico and UK water rights for the cleaner, faster recycling risk of financing the AI boom and global infrastructure.
A pretty compelling swap.
Are they moving from insuring yesterday's municipal debt to insuring tomorrow's? That's the nugget to carry forward and think about in your own investing context. Thanks for diving in with us. We'll talk to you next time.